We are going to talk a lot about distribution engine today. For those of you, just a quick update on why we want to talk about distribution engine. We actually apply for a trademark on distribution engine. And it's end of the year, so thank you everyone for attending the last webinar of 2025. Over the last few years, I was reflecting back on what we built for Cash Portal and what is the thing that is most proprietary and most niche and most unique about Cash Portal. It's not exactly the investor portal. It's not exactly the CRM. It might be the distribution engine and it's the underwriting. We are basically rethinking private equity real estate from the ground up. Traditionally, private equity has been done with spreadsheets that keep track of all the investors' preferred return, keep track of when they invest, when they distribute, and when they redeem. And investors coming at different times, belong to different classes, and have different kind of redemption schedules. And to keep track of that across, say, 200 investors in a fund is just unmanageable. And any fund admin basically takes that spreadsheet and use human labor to create very complex models. So we, being a YC-backed company, decided to turn that model upside down. And that is the essence of Cash Portal, which is we are saying that since all the LPs are doing things on the portal anyway, and the GPs are making distributions anyway, why don't we just take that data and instead of replicating it on a spreadsheet, on a separate system, keep that in the same system, and that is all recorded for future purposes. So Cash Portal then automatically keep track of LPs accrued preferred return, unpaid preferred return, they keep track of how much distributions have been made. And so the account statements and the capital balance statements are just a click of a button away. And so as I look across the industry, that's definitely the most unique thing we have done. So we are in the process of applying for a trademark on our distribution engine, and that is uniquely ours. All the other kind of portals or all the things out there, the fund admins historically has been done using just spreadsheets and plus human labor, and that's why most of the fund admin companies out there start out at 25K a year in order to have someone kind of like run your cap table for you, whereas we are trying to do it with software. All right, so and then just a quick looking forward to 2026 for those of you who came early. 2026 on January, we will have a big announcement where we are rolling out a bank, a cash portal bank. Technically, we are not the bank. We partner with another bank, and where you can create a bank account directly on Cash Portal. And it's a real bank account with very high FDIC insure. And the difference between that bank and say your Chase Bank is that you can make distributions next day or at least 2 or 3 days as opposed to 3 to 5 business days. That's important because right now you are if you use Chase Bank, for example, what technically happens underneath the hood is that the our system is doing an ACH pull against your Chase Bank, and that money is sitting in our bank provider's escrow account for like 2 or 3 days to make sure that that is a legitimate API ACH pull. And then after 2 or 3 days, after the window has passed, then we deposit it into the destination bank account. And so that's why it always takes about 3 to 5 days. And the processing power is a lot higher. The risk is a lot higher. And as such, we charge quite a fee, which is the same as all the other portals. But if you have your own bank or the bank belongs to you, we know exactly how much is in the bank account. So we don't have to wait 2 or 3 days. We literally just distribute because the 2 or 3 days is to making sure that you don't have an insufficient, bank balance so that the money couldn't get returned back to you. And so that's going to be super helpful for folks that are running a ton of distributions. So be on the lookout for that. So that's the banking that's launching in January 2026. The second thing that we are launching in Q1 of 2026 is a accounting software that that basically you can upload your T12 from Resman or Afolio or RAM Manager or like Door Loop, and we basically convert it into our own version of T12 with a profit and loss statement. All the expenses, you can keep track of it. That's launching in Q1. And since this is recorded, you can hold us accountable for that. And what it does is that the, the, the vision that I see with accounting is the following. Right now, people are doing underwriting on Cash Flow Portal, and they end up getting a deal. So really good job. And they're using CRM to raise money. So far, so good. But the problem with the underwriting on a spreadsheet is that you have the year one pro forma, you have the year two pro forma, you have the year three income expense pro forma. You don't really know if you are hitting those pro formas. And so what you do is you download the T12 every month from your property management software. You create a different spreadsheet that plug in the year one pro forma from your underwriting, because that's how much you quote unquote project to your investors. And then you take that against the actual, and then you do a comparison manually. And suppose you have, say, 50 units you want to renovate, and you don't know how many of those units have been renovated, have not been renovated. You don't know, you know your how much you spent so far on those 50 units. And so it's not clear that you can intuitively project whether you are over budget or under budget. And so we're gonna turn that kind of a paradigm around of say you already have you already have the underwriting, which is how much you should achieve, and then compare that against your actual. And then we're gonna give you recommendations on like, hey, you are really like over budgeting here. You are really under budgeting. You should be very careful about spending less going forward. So some of the recommendation will be, hey, make sure you create a purchase order with your property management company when you're doing renovations where you approve the items. We did that for one of our properties, and it has led to great results. So we are moving from investor portal into accounting, fintech, and asset management. And so that's coming up. The goal, the vision is you start with underwriting, you have the projections to your investors. That's something you want to hold yourself accountable to. Then you use our CRM to market the deal. Then you use the portal to raise the money. That's the easy part. Then it comes down to ingesting your accountings into the software, comparing it back to the first step, which is your underwriting, to see if this makes sense, whether you're on track or not on track. Our goal is to make our GPs more capable operators. And right now, some of the friction standing in their way is just lack of easiness, where you are, doing a lot of things at once, and you don't, because of the friction, you're less inclined to do them. So if we remove the friction, make it super easy, like the numbers are yelling at you that hey, you are over budgeting or you're under budgeting, be careful. You're probably more likely to take action. I've been there. We have a over budget in our capex, and now we are actually suffering the consequences by going back and implementing some purchase order system. So I hope that all of that learnings, we are putting it into Cash Flow Portal. Okay. So 2026 will be shaped by fintech, having our bank, that's in January, accounting, that's in Q1, and then also asset management, that's toward the end of the year of 2026. All right. With that being said, let's go into waterfalls and distributions. By the way, anyone has any questions, you can unmute yourself, maybe introduce yourself and make a comment. I'll give it like 5 seconds for folks to ask questions.
Do you do one-on-one trainings?
I'm sorry, one-on-one what?
Do you do one-on-one trainings of your platform?
Yes. So the best way to schedule a training is actually go here, cashflowportal.com/demo, and you'll be paired with one of our account executives. The other way is, that's the best way, especially if you are if you have some questions about the product.
Okay. Thank you.
Yeah. All right. Let's talk about distributions and waterfalls. Okay. There could be like 5 different calls to talk about distributions because it's so much to talk about. So I will go through some of the basics, and toward the last 10 minutes or so, I'm gonna open it up for people to ask questions. There's a lot of terms, so I will try to do my best to explain them. Um, okay. All right. So, all right. People are still coming in, so I am a little bit distracted admitting people into the room. Okay. In the future, we could have someone else just who's admitting folks into the webinar. All right. So the easiest distribution waterfall is a 80-20 split. The way you are going to model this, by the way, is you are on the dashboard. That's your entry point. You click into the deal. You head over to classes. Then at the bottom, there's a distribution waterfalls. If you click on edit classes, there is a way to put the waterfall class by class. But we don't actually recommend that, and we will prefer the customers kind of move away from putting the hurdles here, and set up a call with our customer success to set up your waterfall so you learn the system. So that's tip number one. And the way you set it up is to use that link. Or if you are already in Cashier Portal or you are already a customer, you can just take this Calendly link and save that Calendly, bookmark it. That's how you schedule call. Okay. So again, you can set up the waterfalls here, but we technically don't recommend this. Why we don't recommend this? When you do it this way, you are limited to one type of waterfall, which is a per class waterfall. The better way is to go over to distribution waterfalls, where if you click on the drop down, you can add as many waterfalls as you like. Okay. Now, this waterfall, why this is powerful is that you can usually people set up a asset managing waterfall, which is the operation waterfall, and a disposition waterfall, because those two waterfalls are technically two different waterfalls. I hope that makes sense. Okay. So that's really important. So the 80-20, let's just build the 80-20. So I'm gonna click on add distribution waterfall. I'm gonna do a call it a asset managing waterfall. I'll give a name. I set as default because until I sell, I usually do it this way, right? So now it starts with blank, and then all I do is is gonna be a so it's just gonna be a split. So I'm gonna do a split, 80-20 split. So class A. So in this case, I actually have multiple classes. So you want to give a class of say, the first thing is actually you want to do this way. So you want to do split, okay? Then you break it into multiple paths. This is really important. If you have if you have only A and B, then you don't have to break it into multiple classes. And now under the multiple classes, you can actually do this split on class balance. The first option is you give it, say, I want to split it 50-50. So the money comes in. It's just like a waterfall. The water comes in and then it goes multiple hurdles, right? So if you say 50-50, it says, hey, $100,000 comes in. I'm going to split it into 50-50 right away without any consideration for what's happening underneath. So usually that's not correct. You want to split on class balance. So the first one is class A1. The second one is A2. And the software will automatically compute how much is to distribute across two funds. Okay. In this case, I don't have any investments into class A2. That's why it's 0. But as soon as I investments into class A2, this will be automatic, which is a new feature that we implemented this year. Okay. I hope that makes sense. So that's if you have multiple classes. With class A1, you will do another split, but this is not into multiple paths. It will be A1 plus B, and then this will be, say, 80-20 split. 80-20 split. So that's for A1. For my friends and family, I click on here and I do split and I do class A2. You see, A1 doesn't show up anymore because that path belongs to just the A2 and the GP. And so you do it this way. And then this will be 90-10 split because I'm nice to my friends and family. So that's that. You see? So that's that. So that is one way to do the easiest split. Now, this is already quite advanced because you have an A1 and A2. What does A2 stands for? A2 is could be a side letter you have. It could be anything. Like this is just an abstraction. I call it A2, but I can call it like Z5 or friends and family. So I hope that makes this is all just an abstraction. All right. So that's the first part. Is an 80-20 split. I hope that makes sense. Any questions on this one? Maybe you can comment on it. Okay. So on this part, we talk about this amazing ability to split between A1 and A2. Now let's make it more advanced. A lot of you who are raising money for A1 and A2, you actually don't know if A1 is actually raising 9 million and A2 is actually raising 2 million. Right now, I say it's 9 and 2, right? But you actually don't know. So you just like, hey, I have no idea how much I will raise for each class. The way you do that is you click on new bucket and then you move the bucket to the top. It takes a little bit of a maneuvering. And then you move this class A into the bucket, class A2 into the bucket, and it's just a little bit more difficult. I agree with that. So just play with it a little bit more. Yeah, so A2. And so you can see it adds up to 11 million. And so if you don't know exactly how much to raise for A1, A2, you put them under the same bucket. It's like, as long as I can raise in the $11 million total, I am good with that. I hope that makes sense. Okay, so that's the use of bucket. Now, to be clear, buckets are I will stay away from buckets as much as I can because buckets has all kinds of nuances. So if you could afford not to use buckets, I prefer not to. But if you have a pretty easy waterfall such as this one, then buckets is good. Okay, so that's for the bucket. I'm gonna cancel it so that I keep it without the buckets. All right, so option one, we talk about this 80-20. Any question? Let me pause another 5 seconds for questions before I move on to a 7% pref. Mm. Yeah, very good. All right. So the what we just discussed is actually also called a pari passu. I don't know if I pronounce it correctly, but pari passu simply means all the investors are equal footing and pro rata. So I'm paying my class A and class A1 and A2 simultaneously. So the system is basically if I have $1, I'm gonna split it this way. I have $2, I'm gonna split it on equal footing, as opposed to A1 gets paid before A2. I hope that makes sense. So non-pari passu means that it's prefer plus promote. It's just a fancy word to describe exactly the same thing. I rarely use the word pari passu, but you can impress people by saying, oh, it's pari passu. It just means equal footing. That's all that means. There's nothing magical about it. So this 80-20, the fancy way called 80-20 is pari passu 80-20. Okay, so just so you know that. Okay, so that's all that is. And then if you're doing a option two of the 7% prefer and a 70-30 split up to a 15% IRR, that's just non-pari passu. Okay, so that makes actually less impressive. All right, so we just finished finished talking about pari passu. Let's talk about the option two. How do you model a 7% prefer? And that gets pretty tricky. So that's the first one. All right, so that's the first one. So let me go into our distribution waterfall. And I'm gonna do the 7% pref, like pref plus promote, also called asset managing waterfall with the prefer plus promote. Okay, let's do that. And I'm gonna set as default as well. I'm gonna save. I'm gonna start with a blank slate, and I'm gonna do the first step is non-pari passu. So I have a hurdle. So class A1 and A2 are paid concurrently. So I'm gonna do they have a cash and cash of A1, A2. A1 has a 6% cash and cash, and then A2 has a 8% cash and cash. And again, this is concurrently. If you want A1 to have 6% before A2 to have 8%, then those are two different hurdles. If they are the same level, they're the same hurdle. The best way I imagine it is just a water coming down a waterfall, and then it's like, what's the first hill? What's the second hill? Right now, they're on the same hill. They're at the first level. Okay, so far so good. So that's the first one. Then I say after that, I'm gonna be a split. And a split is going to be actually it's not going to be a split. It's gonna be a multiple path split because I make it super fancy because you have A1 and A2. I also use split into multiple paths. The first path is A1, the second path is A2, and then I'm gonna save. Okay, so first they get their 6% and 8%. Then I'm like, whatever leftover money, give the right amount to this path, give the right amount to this path, because I'm dealing with A1 and A2 separately. This is the kind of the hardest concept to wrap around, all right? And then you say, within the A1, this is A1 and A2, it's gonna be on a 70-30 split. Okay, so I like to save it as I go until click on that add this stop condition until I achieve a IRR of class A for 15%. I'm gonna save it again. So distribute 70-30 until they achieve an IRR of 15%. And then I say split again with the same class A and class B at a 50-50 split. This is what we call the distribution engine, and that's why it's proprietary. Like if I look back on Cashier Portal again, what did we create? Fundamentally, it's this thing we create. This is the most unique thing about Cashier Portal, and I'm very proud when I'm using it. It just works. Now, so you can see A1, A2, 70-30 until a 15% IRR, and then the 50-50 split. That's for that. And then on this side, I will have split between the B, my friends, friends and family, and that might be 80-20 split between 80-20 until a 15% IRR. So this will be IRR, and then there's the class B until class A2 gets their 15%, and then a 50-50 split. And then a class A2 and B and a 50-50 split. Okay. Now, I was told that some other portals, if you have this ability, like basically, if you want to set up this waterfall, and I think one of the customers on the call told me this, that you have to give your operating agreement directly to their team, and their team will then go back to their backend system to implement it for you, as opposed that you do it visually here. So it's not kind of drag and drop. It's literally they kind of like code it out in the backend. So anytime when you want to change it, you have to go back to them and then keep changing it. So what we did is we built the front end to it so that you can manipulate these anytime you want. All right, so that's how you set up with the waterfalls for prefer plus promote across two different classes. Okay, I hope that makes sense. Okay, now I know that sounds pretty easy, but let's talk about something hard. All right, so that's the 7%. So that we just set up the asset managing waterfall. Okay, so far so good. Now, on this one, we do need to set up a sale disposition waterfall. I hope that makes sense because that's just for asset managing. When you sell, this is no longer 6 and 8. When you sell, it is 100% of their money back. So what you have to do is you have to click on add distribution waterfall, and then you say prefer plus promote, and then this could be disposition waterfall plus promote waterfall. Now let me click on this one, copy from asset management waterfall. So you can actually create a new waterfall based on the existing template. And this one is the asset managing, one is the disposition waterfall. So I'm going to save it so you can see this is the disposition. It looks exactly the same, right? But the only difference is that when says this 6% plus 8%, let me zoom in just a little bit more. Instead of this cash and cash, it's actually just the return of capital of class A and B. So I'm going to change it to 100%. So I'm basically saying at the time of disposition, give all their initial capital back and then plus the 70-30, 50-50, and then some 80-20, and so on and so forth. So you make a duplicate of that, of the initial asset management waterfall, and then you change it at the disposition time as a new one, if that makes sense. So that's why you want to use distribution waterfalls as opposed to buckets and classes, because it gives you more flexibility to differentiate between asset managing and dispositions. Okay. All right, so we do need to set up. So the ways I clone the existing one and change the disposition waterfall. Okay, so that's that. Now, I also want to talk about preferred return. Like there's a little bit of a misconception about preferred return. So let me ask you this question. which one do you think this is true? So hypothesis one is that let's say a LP invests $100,000. Okay, so far so good. And then it's a 7% preferred, right? And so on. Which one do you think the hypothesis is true at this position? Is that LP gets $100,000 back, and which is the initial return of capital, and then 70/30. So this is at this position. Hypothesis one, and then 70/30 kicks in. Or hypothesis two is LP gets $100,000 back, initial return of capital, plus 7% pref, let's say over course of 5 years. So 7%, which is 35K more. So it's 135K back. Then 70/30 split kicks in. Let me pause here. What do you think is a hypothesis one or is a hypothesis two? It's a tricky question. Yeah. Victoria said we tell our investors option two. That's annually. That's correct. Yeah. And then Ali said option two as well. Okay, cool. Yes. All right. So you can do either one on Cashflow Portal. Okay. And double check your operating agreement. So this one is good for your LPs. Okay. This is like good for GPs. Good for GPs. GPs make more because they get true up earlier. 70/30 kicks in earlier. Whereas this hypothesis two is that. So this brings me to number 6. If you want hypothesis one, this means the preferred is considered as return of capital. So that's the hypothesis one at the top. At the top, okay? And then hypothesis two at the top. At the top is preferred is considered return a return on capital. On means it's on top of their initial capital. It's additional. On means additional. Okay, so on means on top. That's the mnemonic device. So what does that mean? So if you want hypothesis two, you have to go back to here and change the asset managing waterfall. And then if I drop down here, you see, you have to go into the events section. Okay, and then you can say classify these payments. So the preferred return count towards this hurdle. This is the accrual. There's the non-compounding. There's the accrued capital balance. And then you have to say classify these payments as return of capital. Okay. So if you don't do that, then it's automatically hypothesis two. That's what I believe. Okay. So make sure you chat with the team on is your preferred consider return on top or return of. Okay. Now, technically, by the way, when you go to make the distribution, they have the option for you to determine whether this money is return on top or return off. That's actually a option at a per distribution set. So this current way is usually correct. The default is usually very sound. So when you make the distribution, just making sure that you are very aware of which one you are using. Let me take a detour. This is where the events part comes in. Like, how much difference do you think it makes for the LPs? Let's talk about that. So I'm gonna go out of my Cashflow Portal, investor portal. I'm gonna head over to underwriting. Think you have a free underwriting deal that you can use and you can always play around. And I like to use underwriting as a way to almost project the future. Like, how much am I making on this deal as a GP? So here's what I'm gonna do. So let's talk about how much difference different waterfalls will make for the LPs. The straight split is our base case. So let me hover over here. Straight split waterfall. It's a 19.56% IRR. And the waterfall looks like this. 80-20 during non-liquidation events. And then liquidation events, 100% of the money back. And then 80-20. Very, very easy. In this case, the LPs make a 19.56% IRR. And the GPs make about $4 million in promote here like that. Okay. So let's head over to what if the waterfall is return of capital with the preferred return. Okay, so then head over here, preferred return waterfall. This is return of capital. All right. In this world, the LPs make less. It's about 16.95, which is a 17% IRR. So 17% IRR. This is preferred, and which is also called non-parri passu. In this world, the GPs make a lot more money. They made $6.3 million over the course of 5 years. $2.3 million more. That's a lot. And the sacrifice for the LPs is only about, you can call it like 3% IRR, right? This is still a pretty good IRR for the LPs. And then the last one, which is, by the way, the first scenario is super common. The last one is also super common. The second one is less common. That's what I have seen. So if I look at the last one, if I look at this preferred return with a return on capital, the preferred return is considered return on capital, which is this case. The LPs will get $135,000 back before the 70-30 split kicks in. And because of that, you can imagine the LPs will have a higher IRR, and indeed it is a higher IRR. It's 18.12% IRR, and the GPs in this case make about 5.45 million. Let's call it 5.4 million over the course of 5 years. So this is about $1.4 million. You see, $1.4 million more than the straight split for the GPs. And the sacrifice in IRR from LP perspective, it's only about 1.3% less IRR, right? So it makes a huge difference to the GPs that they choose return on capital. If this is an important if the deal does well. If the deal doesn't do well, then the last option is more favorable to the LPs. Because you have to give all this money back first. And if there's any excess, then the GPs make a lot. So, for example, like let me just do it the other way. Let's just say I go into the waterfall here, and let's say instead of selling it for this amount, 6.5% cap rate. Let's say the cap rate is actually more like, call it 8%. Okay, which is terrible, 8% cap rate, exit cap rate. And so then if I look at this way, just to show you example, straight split, it's only at 11% to the LP, and the GPs make about 600K, right? So far so good. And then the preferred return on capital, because that's the second most common. And then in that world, the LPs will actually make a higher IRR, and the GPs will also make more money on that one. So there's the GPs make 900K, and then the straight split, the LPs make less IRR, and the GPs, it's this number, not I keep looking at this number. In the straight split, the GPs make about 2.4 million. So let me just write this down, so just so that people are aware. So if the exit cap is much higher, i.e. lower returns on the project, then the straight split, it is 11.79%. This is straight split. Yeah, straight split. And then the GPs make about $2.4 million. $2.4 million promotes over 5 years. So far, so good, right? And then we can skip this return of capital because that's not as common. But if I look at return on capital, this will be prefer return on capital. Make this the active version. This is a 12.38% IRR. And then GPs make 2.1 million promotes over 5 years. So as you can see, the tables are turned if the project has lower returns. I hope that makes sense. This takes a while to kind of like synthesize. If the project does very well, the return on capital preferred will have a less IRR than the common straight split, and the GPs will make a lot more because they have more upside. If the project doesn't do well, then the return on capital preferred will actually give the LPs more IRR and the GPs make a little bit less. Basically, it builds safety for the LPs. So it's not like return on capital is always better for the LPs or worse for the LPs. It just, if you look at the risk profile, this one is basically the return spectrum is tighter for the LPs. The LP cannot lose that much basically, but they also couldn't make that much more. And so whereas the straight split, the return spectrum for the LPs is a lot more wider, which means the LPs could make a lot of IRR, or they can make a lot less IRR. But the problem with that is the GPs really like, even if the project does really, really well, the GPs don't really make all that much. Okay, so straight split is most common, it's the easiest to explain. But technically, from a risk profile perspective, I will say return on capital preferred is the better, and that's why institutional investors want that, because it reduces the variance for the LPs. I think this is worth watching a couple more times to really internalize it. Any questions up to this point? Anyone want to make a comment before we go on to the debt funds?
Hey,
Hey
Perry.
Perry, you're
Yeah.
probably going to get to this, but I'm glad you're doing this because you and I and your team and I have gone through waterfalls before, like when we were doing distributions on our latest deal. And I guess the question I have, I don't know if you can answer it here or if it's something you want to give some thought about, but what is going to be the easiest way to explain the waterfall to our investors? You
Mm.
know, because it there's so many moving parts, and in some cases they're just trusting us. In some cases they're just trusting us, but I would like to give them more transparency into what's going on, either graphically or otherwise. I don't know if there's a tool for that or if you have something for that. So could you comment on that a bit? And if that's something that you're planning to do in the future, you can tell me that, and I'll
Yeah,
work with that.
absolutely. So on the underwriting, if you go into the pitch deck and you go into this pitch deck, if you head over to waterfalls here, it's right here. It bases a non-liquidation event, you get a 7%, then 70-30. On the refinance event, you get a 100% of the money back, then 70-30 until a 15% IRR, and then the 50-50 split. This is your projected cash flow on a yearly basis. So a lot of people just take a screenshot of this, or they click on generate pitch deck. And so again, this is free for your first deal. So you can just take a screenshot. This is my first thing, and this is my second thing. Like basically what we present to you, it looks better if you zoom out a little bit. It looks like that. Okay. Yeah. So that's what that looks like. Yeah. So that's one way. Like basically, when you present to your investor, fewer the words, the better. And you just say it this way. This is like the least amount of words to describe what it is. You don't have to explain on capital versus off capital. You don't have to explain that. I don't see really investors explain that. If the investors are so inclined to look into the operating agreement, they can buy. Like I have seen so many webinar decks. I don't see that. So there's that. But yeah, like usually when you explain the waterfall to people in plain English, it's usually this way. The other thing I will also mention is the following: is if you come from certain mentorship groups, they like to use 80-20. And I think 80-20 is a very, very good waterfall. It's like the easiest way to explain to them, and you can actually prove it based on underwriting that the 7% prefer up to a 15% IRR with a 80-20 and then 50-50 split. If the deals is generating about 17% IRR, the investors literally get the same amount in both sides. And if the deals perform extraordinarily well, the investors actually come out ahead with the 80-20. So I use 80-20 for most of my deals. And when you do all the math, it came out to be very, very similar. So if this is one of your first deals, do 80-20. Just do 80-20. It's the easiest way to explain. You don't have to. Everyone understands. And then if you go a little bit more advanced, you can do the preferred return. I'm not a fan of like a hurdle up to a 12% IRR, then another hurdle up to a 15% IRR, and then another hurdle up to a 20%. I don't like those too many hurdles. It makes it overly complex. So that's that.
What does your pitch deck look like?
Yeah, so I'm gonna click on generate pitch deck. Just take about like a couple minutes.
I think what he was taking look, what he was saying was in regards to like a graph, like an ROI graph with a bar, and like here's a situation now, and then best case scenario, this is what your return on your investment is on if we hit this number in this amount of days. And I think that's kind of what it was looking at as far as like
Hmm.
something you could show investors as far as that. That's kind of what I was thinking the same thing too.
Yeah, that's right. Okay.
I don't know
Hey,
if that's on the
Perry.
pitch deck or not.
Although, you know what, going to that page, I forgot about that page you just shared, Perry. We could create some type of chart from that, something graphical from that. So,
Yeah, exactly. So
yeah.
the webinar deck that we end up creating looks like this. So you can see the waterfalls. We have these non-liquidation event, and then refinance and sell event. And so you can also make a chart like this, and then you can see the projections for year one, year two for all the classes. Um, so this is under the waterfall section. You can see these are the projections. This is all the rank comps, and then these are all the images. We generate this table, this photo on your behalf. So all the nearby employers, and then you can see there's the asset. There is a bunch of photos. So this is what a initial pitch deck looks like, and you can obviously morph it into your own pitch deck. This is one way you can take a screenshot of this and then put it into your own pitch deck. The other way is what Ray said. You can take a screenshot of these and you put it into your pitch deck. The last way is you can export it as a spreadsheet. And then that's literally just a spreadsheet. You open up the spreadsheet and then you can take a screenshot of that and then put it into yours. Okay. All right. Got it.
Hey, Perry.
Yeah.
Perry, this is Raj. Hey, thank you for that feedback on the waterfall and one of the other comments that the question that you have. I think that your suggestion of keeping it 80/20 is spot on. And a lot of times when we go to like a family office or a private equity, they'll make it complicated sometimes
Yes.
for
Yep.
whatever reason. So it's always better to start out with the 80/20. And if they
Mhm.
want to change it, let them change it as a counter.
Yeah, that's right. Yes. So I just chatted with the team and they believe that this so 80/20 is actually quote unquote probably the most favorable to the L to the L to the LPs because you can see here they are making okay. Um so let me refresh this page. Let me just double check on this one. Okay. So there is the 80/20. So there's the 80/20, and then let me do the straight split here, the most straight split. Oh yeah. So the straight split here was getting a 19% IRR. Not sure why so you can see the GPs make a lot less money on this 2.1 million. So straight split is technically most favorable to the LPs. So you can see straight split GPs make 2.1. LPs get a lot of money back. Then, if you have the preferred return of capital, which is the second, uh, uh, this is better for the GP. GPs make about 4 million, so make a lot more money. So there's that. So preferred return, and then the IR drops down to 16%. Then finally, if it's return on capital, the GPs should make even less money. So let me click on that. So the GPs make about 4.3 million. So if you do all the math, if the IRR, if the deal is around that range, it really doesn't make that much of a difference. But yes, initially your deal should be straight split, and then when it comes to more advanced, it will be more on the preferred return. All right, and then veteran, you're gonna ask something? Go ahead.
Hey, Perry.
Yeah.
Yeah, thank you. So, I was wondering, I'm sorry, I joined like a few 3 minutes late, or maybe I'm gonna ask something that you already mentioned. Is this system incorporated with like a CRM? Do we need
a separate CRM tool to work with this with cash flow portal or not? And then the underwriting. Can we, when we underwrite using this system, do we need to like, because sometimes we do phone calls to actually check with the comms to actually uh, so to check the how much you are charging for rent and stuff like that. Can we rely on the comms from this system and not make those calls? Or that's something I don't want to understand.
Yeah, so there are lots of questions going on. Thank you for asking those. When you go to assumptions, we have this thing called rank comps. And then if you click on this get rank comps, we automatically parse your address here. And then you can say, let me get the 2 bedrooms for this particular address. And then this will automatically fetch all the 2 bedrooms. And you can also say, let me get my 1 bedrooms for this address. Click on this. And then the all takes about 5 minutes. And then all the 1 bedroom get populated. Then you can say, hey, I'm going to filter by all the 1 bedrooms and the 1 bathrooms. And then I'm going to click on apply. And then that's all my 1 bedrooms and 1 bathrooms. Okay. And then you can see now to your question, can I check these comps? Do I have to call? And my answer to you is, by the way, you can see here why you say, why do I have 2 villas at Decatur? That's because one is a 575 square feet. The other one is 725. That's why we have 2 entry points for this guy. Then you say, hey, this is good, but I don't really trust this. I'm going to click on this shortcut that go to Zillow, and then that will automatically go to the right place. If that doesn't work, we will click on Google, and then you can easily find it. So what we do is we give you a shortcut to find the rank comps, but ultimately, do you trust these numbers? This is just a reference. We are definitely not saying these are the final numbers. We are definitely not saying these are the final. So we basically make it super easy to look up the rank comps. The last thing that a lot of people do is you can click on upload rank comp, and then you can actually upload a CoStar report, a Excel file, if you have a CoStar subscription, and we will parse all of those rank comps into this format. All right, so that's on the rank comp. So this is definitely makes it a lot easier to look up rank comps, but ultimately you are still the one that determine which rank comp are you going to use. Okay. And we get these rank comps from basically apartments.com, and then we use an API called Rentometer. All right, so then on the CRM side, we have a separate CRM that, again, schedule a demo. In here, you can see, you can put this CRM and then put them into a pipeline. So if I go into pipelines here, right here, like you can say, I'm on a call with Marine, and I want to take some notes, and then I think they have a really good chance of investing in my deal. I can do meeting happen, and so on and so forth. So you can go from underwriting to basically fetching the investors for this particular deal to doing rank comp. So we support all of those. It just takes a while to get used to this. Okay, so I hope that answered your question.
Okay, yeah, just a little follow-up, please. So, because what we do now is we use a spreadsheet synthesis. So, I'm assuming that everything about underwriting to investor returns, closing, everything is on this system. Is that correct? Everything about underwriting.
Yes, that's right. We have the entire underwriting model right here. So you can see this is my expenses, this is my capex, that's my finance and uses. And then if I want to see, say, what happens when I do a refinance, I can do actually refinance on my 3rd year, 6% cap rate, 80% of refinance interest rate is 5%. This is my prepayment penalty. And then my IRR jumps to 24%. And then you're like, oh, that seems really too good to be true. If I change it to 70%, my IRR should have jumped to a little bit lower, 23. And you can see the refinance does happen because if I go to projections here, you can see here, class A on the 3rd year, there's money coming back on the 3rd year. Okay. But if I turn off the refinance, this will go back to 11%. So if I turn this off, this will change in a second.
Oh, okay.
Yeah,
This looks good. It looks good. Thank you.
Yeah.
So is there any ongoing training for this, or because like to transition from the spreadsheet to this one?
Yes, 100%. The best way is to schedule a demo via cashflowportal.com/demo. Okay,
Okay.
cool.
All right. Thank you.
Yeah. Yeah.
Hey Perry,
Go ahead.
Dami here from Westwood Capital. Can you hear me okay?
Yes. Hi.
All right. Thanks for putting this together. My question slash feature request is that do you have does cash flow portal have something for K1 issuing?
Like creating your K1s or
Yes, like a built-in feature
yeah.
for creating K1s for
Yeah.
investors.
Good question. So we have accountants that can help you do that. It will be a very bad thing to create K1s without being CPA certified. And so we
Yeah,
are not a
that's
CPA.
exactly the reason for my question. Do you
Yeah.
have people on the back end that
100%.
handle
So
it?
the way you do this for everyone that's watching, you go to resources, you click on uh vendors, and then you go into CPA. Okay. And we recommend two CPAs. One is the vertical the Vodum, and then we also recommend provision. So if you reach out to us, actually we will be happy to give you some recommendations. And then if you tell them that you come from Cash Portal, they usually give you a nice discount for your K1 preparation.
And we do have CPAs. The question really is there a plan for a built-in feature where we can download that directly from the system?
Yeah.
Because you do have competitors that have
Yeah.
this feature, right?
Right.
Mhm.
We have
Is that
this
something in the
fun
pipeline?
admin feature that allows you to create your K1 drafts. And then if you click on this button, you will literally have your K1s, not this one. Let me choose a better one like this. Not this one. This is Bellevue Square. Okay, let me go to the Monarch Apartments, go to Fund Admin, go to K1s, and then go into here. And so you can see on this one, this is the ordinary loss, net income, and then that is my initial capital balance, ending capital balance. So that's because they are putting in all their income and expenses. That's why we talk about on the income and kind of the accounting side. Now, this is a add-on. This is not like included with the portal. This is
Okay,
part of the fund
got
admin.
it. Okay.
So I will say there is no way to basically computer generated K1 that's without the stamp of approval of the CPA. Now, if your CPA charging you quite a bit of money, then definitely you can go through our network to get a discount. But I don't think that is something you can really like eliminate the cost of, unfortunately. Yeah.
Mhm.
Okay, hi Perry.
Yeah.
One more time. So does this system understand like synthesis underwriting? If is there a possibility to upload it and it interpret it, use its AI engine to interpret it and populate it here?
Unfortunately, we don't necessarily do like you cannot upload a Lone Star Capital or you cannot upload a Michael Splunk spreadsheet. We basically create our own spreadsheet. However, something we do really well is that if you upload your T12 and you head over to Insights, we actually point out all the anomalies about this T12 that you should ask your questions for. So like it will say property insurance and property tax are both zero on month 12. Yeah, it is there in D0 and they're color coded to be zero. And then you will say, hey, remember this number 4 here? This is only $12,000 in cell M86. So cell M86. Yeah. So everything was 21,000 except for this month 12 is 12,000. So be careful. This is something fishy going on. So we give you kind of this pattern recognition about your T12, but we don't have pattern recognition and populate the numbers directly on your Michael Blanc spreadsheet.
Thank you.
Yeah. So this is one of the most beloved features about like detecting what's going on with your T12, and then so you can go back to the seller and say, hey, I don't think you gave me the right T12, or at least the numbers don't make sense. So, but we can actually point that out.
Yeah, at least this looks good because
Yeah.
currently
So
we are using other GPTs to do that. So if
Yeah.
we can just do this in one click, that's good, right?
Yeah, that's right. You upload that, and then also you can upload your OM. So this is this is the OM directly from the broker. There's like, I just
Mm-hmm.
download this OM. And then
Yeah,
if
yeah.
you upload that, we automatically parse the assets. So including the site and the construction, the roof. So you will see like plumbing, this is hot water, foundation, wiring, and so on. And then it also extract all the photos directly from your OM. This is not using ChatGPT. This is just like we know how to parse photos. And then we do use ChatGPT to parse the market details. Like basically we rephrase this, and this is your pitch deck. And then you're like,
Mm-hmm.
oh, I don't want these photos. Then you can pick from the library of like, okay, what other photo do I want? I like this photo. Maybe I like this photo. So I can pick this photo, and I scroll down, I click and select this image. So I added one more photo here. And then this is for market, and you can do it for employers and so on and so forth. Okay.
Okay.
Hey, Perry,
Go
this is
ahead.
James. Question regarding the uploading of the T12.
Mhm.
Does your system parse that T12, or do we have to have a pristine T12 or clean
Oh,
data
you can upload literally any T12 in the world
in
at this point,
any kind of
and
format?
any format in Excel sheet or PDF that we will parse it correctly. Yeah.
Awesome. Okay.
Yes. So that is that's yeah, like at the beginning of this call I mentioned I look back on Cashflow Portal and see what did we actually create that is a differentiator. And it's literally just the distribution engine and underwriting. Everything
And it,
else is kind
it
of like for CRM, you can go high level. There's nothing really like differentiating about it. It's really good. Let me talk about CRM actually. The reason that our CRM will be very better than a typical CRM for the GPs in the long run is that we are the only way, this is the only way that you can machine learn what you did with these investors and how they converted into becoming investors. So they came in as leads. So you go on a call with them, you write down some notes, and then you write down who they know and so on. So you put a lot of data in here. Then over time, we're gonna automatically learn. Like what else do you know? When you send out the offering, when you send out the landing pages, like so you can create these websites, you can basically replace your website. When you send out these landing pages and your investor portal links, there will be a way to keep track of who click on it. And if they're part of your CRM, then you know, oh, these people are clicking on it and this tied to my investment. So the reason you're having a CRM is to help you get more investments. When the data is in the same platform, then it's a much easier way to learn. If they're not on the same platform, then good luck. And so that's how we win in the long run. And so just a heads up on the CRM. So that's
Yeah.
why. Mhm.
Yeah. A follow-up question, please. So with this CRM, are we required to keep our current website, or you can create a website just in
Yeah.
here? And
Unfortunately, you have to create your own website, which is
okay.
you can give a subdomain of that website so that we can populate pages of that website. But I think getting a website though, like with Squarespace or GoDaddy, is very cheap. Like all the domain stuff, you still want to have your own website. But go ahead,
Okay.
keep going. Sorry,
Okay,
cut you
that's
off.
good. And then the second question is, so are we required to create a new phone number in this system, or we can use our current phone numbers?
Unfortunately, it will be a new phone number. So texting, yes, we have texting, but I believe this is only for new phone numbers. Yeah, it
Uh,
will
uh,
assign to a new phone number. Yeah.
that works. Thank you.
Yeah, that's right. Cool. All right. I know we only have 2 minutes left. Let's catch up next time because I also want to talk about debt funds. Talk about GP catch up. And I want to talk about European waterfall and American waterfall. You can take a screenshot of this. What each one means. So European is more common, more favorable to the LPs because the promote only kicks in when the fund returns. American is just promote kicks in when any asset sells. And so flexible funds technically fall under this bucket. Okay. So there's that.
Uh, Perry, can I ask one last question, please?
Go ahead.
So, is it possible like to create a template for the waterfall distribution and always use it all the time? Because if my
Yeah,
distribution,
yeah,
if I
yeah.
use the same method, I
That's
don't want to
easy.
keep one template
Yes.
and then use it.
You can 100% do that. In fact, for
Okay.
underwriting, all of those waterfalls, they are part of this library. You see, this is all the
Mhm.
library, and then anything you create, you can save it as a template as well.
Okay.
Yeah,
Thank you.
yeah, that's right. The reason that I know we started with distributions, waterfalls, and then we ultimately end up AI underwriting for the following reason. Underwriting, let me just go all the way to the top. So there's an interesting fact I observed. We started with distributions and we end up on underwriting. Why? Because underwriting is basically a way to see the future, right? You basically map like different types of waterfalls, different assumptions, and this is a way to see the future. Take your favorite spreadsheet. How do you take the same assumptions and switch between different assumptions? How do you switch between different waterfalls about the future? How do you toggle between straight split, preferred return, return of capital, or like let's say you have a pref equity partner. We can also do that if you have, say, a pref equity partner. So that's why we always come back to underwriting. And people just naturally get drawn to like, hey, I really want to talk about underwriting. So that's a very interesting way. All right. I think this is the last webinar of the year. So thank you everyone for attending. I will leave you with this. You schedule a call to talk about anything, and that's cashflowportal.com/demo. Cashflowportal.com/demo. So go here and then go click on schedule a demo. This is how you get a demo on anything. Best way is to get kind of like isolate that demo to just talk about underwriting, isolate the demo to just talk about CRM and so on. We create a operating system across the board. So it takes a while to learn about each part of the system. And then if you have any more questions, check out our YouTube, schedule a call. Next year, I think with the lower interest rate, I think the Fed is gonna announce the interest rate again before 2 p.m. today, Eastern time. So right now, I guess. So next year could be a year with a lot of deal volume. So having a very robust system is gonna pay dividends as you face next year.
Could we get access to that Google Drive file that you have from the previous trainings?
Oh yeah, you can. This is actually open to the public. Yeah, so go for it. Yeah, so there's nothing confidential about it. So yeah, go ahead.
Great.
You
Thank
can
you.
take a copy of that. All right, this will be uploaded to YouTube in the next week or so. And thanks again for coming. And I actually apologize for why this waterfall didn't exactly make sense. So I owe everyone a video afterwards, and then I will create a separate video on this part. So apologies about that. It's I'm a little bit off the game because this is supposed to be our differentiator, and it doesn't exactly make sense when I look at the numbers right now. I think something happened in the last day or so. Okay. Anyway, thanks everyone for jumping in, and happy New Year's, and see you all next year.